This session, I'm going to look at Nvidia's quarterly earnings report that came out last week, August 28th of 2024. But it's really a session about the power of expectations. In finance, in life, how we set them, what happens if we set them too high, and what happens if we disappoint relative to expectations. So let's go back to last week, August 28th of 2024. Wednesday, we were waiting for close of trading. Why? Because Nvidia was going to report its earnings. Why so much anticipation around one stock? Well, every market is dominated by a few stocks, and for the last couple of years, Nvidia has been the center of this market. So as people were waiting, there was rumors floating around as whether it would contain good news or bad news, and the earnings report comes out right after close of trading, and it contains some incredibly good news. Revenues were up 122% relative to the same quarter the previous year, an astonishing jump for a company the size of Nvidia. Margins were sky high, gross margins of 75%, operating margins close to 65%, net margins of 55 to 60%. Great news, right? But here's what threw people off. In the minutes after the report came out, the stock price dropped and it continued to decline the next day. It was down about 8%. And to put that 8% into actual numbers, that's about $200 to $220 billion in market cap wiped out in one day. And in the days since, the stock has continued to drift down. It's now down about 16 to 18% from where it was when the report came out. I want to use this session to talk about that report specifically, but talk more generally about earnings reports, because these are the mechanisms that companies use primarily to reveal information about themselves. And there's an entire dance or a game that goes around earnings reports that's fascinating, because it gives you some insight into how markets actually work. Now, just to give you some background on how I got interested in earnings releases. My first exposure to financial markets in depth was in a classroom. In the classroom, when you talk about markets, you talk about information arriving in markets and markets reacting to that information. But it's all a little bit abstract. How does information arrive? What is this reaction? In the decades since, I've actually become fascinated with earnings reports, because those are the primary ways in which information arrives at markets, and they give you a microcosm of market reaction of what happens around earnings reports. Incidentally, in a previous life, almost so long ago, I don't even remember what the exact title of my dissertation was. This was the basis for my doctoral thesis: how distortions in the information process, delays, lies, restatements affect stock prices and stock returns. So let's talk about earnings reports. If you're a publicly traded company in the US, you're required to reveal, you have disclosure requirements. Those disclosure requirements have always been around for publicly traded companies, but they became formalized after the Great Depression. The Securities Exchange Act of 1934 laid out that if you're a publicly traded company in the US, you have to have an annual filing within 90 days of the fiscal year ending, and quarterly filings within 45 days of each quarter ending. In the decades since, that timing has been adjusted down because technology has made it easier for companies to disclose their financials. So all US companies have to have annual reports and quarterly reports. Now, if you combine that with the fact that most companies don't take the entire 45 days or 90 days. They report within 2 weeks of a quarter ending, and 65% of U.S. companies have calendar year ends, which means their fiscal years run from January to December. You can see the logjam coming, right? Because 65% of companies then have fiscal years that end in December 31st. Their annual filing comes out in the middle of January. And that same 65% are going to have quarters ending in March and June and September, and you're going to get the quarterly reports coming out a couple of weeks after that. That's called earnings season, that period where the bulk of companies report their earnings reports. But the other 35% have fairly quirky fiscal year ends. Nvidia is a particularly quirky one because its fiscal year ends on January 31st of each year, which means that we're right now in Nvidia's 2025 fiscal year. It's strange, but that's the way it works. And Nvidia tends to come out with its earnings reports within a couple of weeks of each quarter ending, which means the August 28th earnings report is actually the earnings report for the quarter ending on July 31st. So with that lead in, let's talk about what happens before the earnings report comes out. There's an entire ecosystem at play here, right? Companies are tracked by analysts. Analysts put out buy and sell recommendations, but a great deal of their time and effort is spent forecasting what the next earnings report will contain in terms of revenues, but often in terms of earnings per share. In fact, analysts, the day after the earnings report comes out, start making judgments about the next quarter's earnings report. It already started with Nvidia, and they'd come out with an earnings. They essentially come out with expectations of what that earnings per share will be. They revisit those expectations in the days, weeks following, as information comes out, and the information they use is wide-ranging. Some of it relates to the company itself, its history of delivering earnings and operations, and any news releases that come from the company. Some of it comes from the peer group, because if you're the fourth retail company to report earnings and three other retail companies have already reported earnings, analysts have learned from those earnings reports about how retail companies are doing. Some of it comes from looking at other analysts. I mean, analysts like to claim they're independent, but the truth is it's human nature to watch what other people are doing, which is one reason when you see revisions of earnings estimates upwards on the part of one analyst, you often see other analysts revisit their earnings as well. And finally, they do look at macro data to the extent that it might affect their company's revenues and earnings. If you're a cyclical company, it could have an impact. So they use all of this ammunition to try to make their judgments. And in the US, you can actually track these judgments in public sources. You can go to Yahoo Finance and see what the consensus estimate of earnings per share is for the next quarter, the next year. If you're willing to spend a little money and subscribe to Zacks, you can see not just that consensus, but the highs, the lows, the disagreements, the revisions over time. So that's part of the expectations game, is what analysts and investors are doing, trying to forecast what the next earnings report will contain. Now let's look at how that played out in Nvidia, one of the most highly tracked and followed stocks in the market. 70 analysts track it. Most of them make estimates of at least earnings per share. Many of them make forecasts of revenues. And in the days leading into the second quarter report on August 28th, those expectations were starting to gel. The earnings per share were expected to be about 64 to 65 cents per share. The revenue is about $28.5 billion. But that was the consensus. Now, within analysts, there was some disagreement. The earnings per share numbers range from 60 to 68 cents, and the revenue numbers had a low of 26 billion to a high of 30 billion. So there's an expectations game at play. Analysts are setting expectations. Now, while analysts and investors are setting expectations, the market's not staying still. The first thing that's, of course, changing as expectations get revised upwards or downwards is the stock price. And Nvidia's stock price leading into the report. So this graph looks at the trading days since the first earnings report came out on May 22nd. So between May 22nd and August 28th, you can see the stock price go up and down. It's been a volatile quarter. In fact, during the course of the quarter, on June 10th, the stock had a 10-for-1 stock split. Then on June 18th, it hits all-time high at $135.58. Just a few weeks later, on August 5th, during the course of a market sell-off, it hit a low for the quarter of $92. You can see the wild swings, but the stock has recovered somewhat between August 5th and August 28th, and leading into the earnings reports, trading at about $128 per share. So the expectations game is set. Let's talk about the other market metric you could look at to get a sense of what the earnings report contains. You could look at the volatility in stock prices, and you could look at volatility in multiple ways. You can look at the historical volatility in stock prices themselves, and as you saw in that previous chart, the stock has been volatile, and you see the volatility jumping in the weeks leading into the second quarter report. The other volatility you can focus on is a forward-looking number. It's called an implied volatility, which you get by looking at options on Nvidia that are trading the price they traded and backing out from the option price the volatility. And you can see that number jumped as well. They're saying that's to be expected. An earnings report is coming. This report seems to be unusual in terms of the amount of volatility increase you're seeing. You see a little jump before the first quarter, but this quarter clearly investors are much more in disagreement about either what the report will contain or what the market reaction to it will be. So you got the timing, you got the expectations game. Let's turn to the actual event. When you look at an earnings report, the earnings report contains, especially in the US, quarterly earnings report include all of the financial statements that you see in an annual report. The income statement, the balance sheet, the statement of cash flows. So quarterly earnings is almost as detailed in terms of the financial statements as an annual report is. Some of the footnotes might not be as complete, but it is a full financial statement. So what companies usually report in a quarterly report is what happened during the quarter, what happened in the same quarter the previous year. They'll also report the cumulative numbers they have for the quarter so far. So, for instance, for the Nvidia second quarter report, you get the second quarter numbers, you get the numbers for the first and the second quarters put together, and you get the comparison to the same numbers in the previous year. So I'm going to focus on the Nvidia financial statements that came out in the quarterly report and see what we can learn about Nvidia from the financials. And as I said, the numbers are incredible. If you look at the revenues in the second quarter of 2024 at $30 billion, those numbers were 122% higher than they were in the same quarter the previous year, 122%. If you look at gross margins measure unit economics. You say, what the heck is unit economics? They measure what you make on a percentage basis on the next unit you sell. And the unit economics for Nvidia are mind-boggling. If you look at the unit economics, 75% gross margin. That's in not just the top decile, the top 2 or 3% of all companies out there. Saying, why is the margin so high? Well, here understanding Nvidia as a company helps. It's a semiconductor chip company, but it doesn't make its own chips. It's a design company. It designs the chips, so its power is in its research and chip design. TSMC, Taiwan Semiconductors, makes the chips for it. And clearly, Nvidia is able to mark up those chips by an immense amount, 75% gross margins. Great revenue growth, great gross margins. And wait, it gets better. If you look at the operating margins, which looks at what's left over after your other operating costs. So it's a measure of economies of scale. If you have great economies of scale, as you grow, your operating margin will tend to grow with you. The operating margin is also mind-boggling high, 62% again in the top 2 or 3% of all companies. Great revenue growth, great gross margins, great operating margins. Then I looked at net margins. Net margins look at the effect that leverage and taxes have on your earnings, and neither has much of an effect in Nvidia. Nvidia has almost no debt. It pays a 13% effective tax rate. Its net margin is 55%. Again, astonishingly high. So if you ask me to focus on what the last quarter's reports look at, the numbers are astonishing. This is a great earnings release. But embedded in this table are also the seeds of disappointment. The revenue growth of 122% is amazing, astonishing, but it's lower than the 200% plus growth that Nvidia posted in the previous 2 quarters. The gross margin, the operating margin, the net margin that I marveled at are all amazing, but they're below what they were in the second quarter. Nvidia had a great quarter, but relative to what it had done in the previous 2 quarters, there are signs here that things are starting to level off. There are signs of peaking. It's 1 quarter. Things could change around. But there are the seeds of maybe, there is a slowing down coming. The slowing down will still look amazing, but it's a slowing down from some amazing numbers. Now, incidentally, quarterly reports from U.S. companies include not just the financial statements, but many companies, this might not be required, but many companies do. They provide guidance for what the next quarter and the next year will bring. Why do they do it? Some of it is to provide investors with information. It is benign. Some of it is to kind of modify and manage the expectations game. Companies are trying to get analysts not to overestimate numbers so that they can beat them. So and if you look at what Nvidia provided as guidance with its second quarter report, it was sobering. It's sobering in the sense they said, look, no, we see growth slowing down and margins will have kind of peaked. I mean, those were not the words they used, but that was the message. And in a sense, they're preparing investors were saying we've had an incredible couple of years, but things are starting to slow down. We're scaling up, our revenue growth has to come down. Our margins are coming under pressure as competition will start to increase and we'll get pushback. So clearly there is news here about a potential slowing down as well. And there's a final piece of information that was in the quarterly report. Nvidia said, announced that its board had set aside $50 billion in buybacks. You're saying, so what? Well, when companies buy back, it's cash leaving the company. And if your story for Nvidia, it's a company with almost unlimited growth opportunities. They can keep growing at 200% a year. The $50 billion buyback is a reminder that that might not happen. Now, earlier this year, I talked about Facebook and Google announcing dividends for the first time. And I said it's a signal that they're sending saying we're growing up, we're slowing down. I mean, Nvidia, intentionally or not, is sending a signal of, hey, we might have hit our peak greatness last quarter. Things are going to slow down. We're still going to be a great company, but the numbers are not going to look as impressive. So we've looked at the timing, we looked at expectations, we looked at the actual event. Let's look at what happens in the aftermath. The market gets the earnings report and it reacts. And there's history that suggests that earnings surprises affect stock prices. Now, there are hundreds of studies that have been done on this. I'm going to compress the results of these studies into a graph that breaks down earnings surprise into 10 groups, from most positive to most negative. So the surprise is the difference between the actual and the expectation, then looks at what happens to stock prices around those surprises. Let's start with the unsurprising event, which is when you get a positive surprise, stock prices tend to go up. When you get a negative surprise, stock prices tend to go down. But there are a couple of quirks that are worth focusing on. First, there tends to be a drift before the report comes out. In other words, the price starts to drift up for positive surprise before the surprise is even known. What does that tell you? There's some leakage of information happening. I'll leave it at that. But there's also a drift that happens after the earnings report. A positive report comes out, the stock price jumps, but then it continues to drift up. A negative report comes out, the stock price drops, it continues to drift down. That is tradable, and there are people who actually try to trade, but before you get too excited, it's a fairly small number. We're talking about basis points sometimes rather than percentage points, but clearly earnings reports affect stock prices. And if you look at Nvidia, we have a history here of earnings surprises and what the market does. And I've listed out the earnings surprises that Nvidia has had over its last 20 quarters. Take a look. In 18 of the 20 quarters, Nvidia's actual earnings have beat expectations. Now, barring 2 quarters in 2020, in 2022, the company has had an astonishing record, 18. You're saying, how can that be? If expectations are set fairly, you should be able to beat them only half the time. Well, there are 2 readings of it. The first is that the AI business has just been so much better than people expected that it keeps beating expectations. The other is that Nvidia is a technology company. You're saying, so what? Its biggest capex is R&D, and R&D is treated as an operating expense. That's a discretionary item. Technology companies have a much better record of beating actual expectations because they can, in a sense, adjust their discretionary expense to beat expectations. It becomes easier to beat the expectations game. Now, before you get too excited about beating expectations, if you keep beating the analyst expectations quarter after quarter, you know what the market does, right? It expects you to beat expectations to break even. It's a very quirky, it's almost a perverse process. That the more you beat expectations and the more and the more sustainable this beating becomes, the more you have to keep beating them to win. So Nvidia comes out and it actually beat expectations on its second quarter numbers, but it didn't beat them by as much as it had in previous quarters. So if you look at the previous page, it beat earnings expected by only 6%, but relative to what had happened, the double-digit beats in the previous quarters, it was a disappointment. So some of what you're seeing is the expectations game playing out in full bore. The numbers come out, investors look at them and say, this is not as good as I thought it was going to be. And the price adjusts. It's the way markets work, it's the way, and it's what makes this process so fascinating. So let's look at earnings reports and let's see what we're trying to get out of them as people, as market participants. To set up this process, I'm going to go back to a device I've used before, using the contrast between value and price. You think, oh, words we use interchangeably. I don't. For me, value is driven by cash flows, growth, and risk. They're driven by fundamentals, and we try to estimate value with an intrinsic valuation model. Some of you might call it a discounted cash flow model. Discounted cash flow model is just a way of bringing in cash flows, growth, and risk into a device to estimate the value of something. So that's what drives value. What drives price? Demand and supply. And you say, aren't demand and supply driven by fundamentals? Absolutely, but they're also driven by mood and momentum. In fact, we have 50 years of behavioral finance telling us why prices can be different from value. You have the pricing process, the value process. And because they can yield different numbers, they can be a gap. I'm going to use earnings reports to talk about what people learn out of them based upon what game you came to play. You're saying, what are you talking about? If you're an investor, here's how I see your game. You value companies, you look at the price. The price is less than the value. You buy at that price, and you hope the gap closes. You know how you use earnings reports? You look at earnings reports to see if it changes the value of your company. What does that mean? Well, is there anything in the earnings report that changes your cash flows, your growth, your risk? Which is another way of saying, is there something that has changed the narrative for your company? Because to me, growth and risk and cash flows come from the story you're telling about a company. So when an investor looks at an earnings report, he or she is looking for clues of, is there something in this report that changes my story for the company? By changing my story, it changes my revenue growth, my margins, my reinvestment, and my risk. So an investor is looking for those clues. So I'll give you examples of things that change the value of a company. A company that comes out and says it's entered a new market, either for a product or a geography. Right now it doesn't make money, but it's a potentially huge market. By itself, that's not changing your numbers very much. But as an investor, you're saying, that's interesting. That could change my story for the company. I remember in 2012 when Facebook reported finally found a way for its platform to work well on smartphones. Huge breakthrough. It changed my value for the company. So you look at an earnings report, you're looking for changes in your story. If you're a trader, what are you looking for? The key drivers of price, of mood, and momentum. You're looking at earnings reports saying, is there something in this report that changes the mood, changes the momentum? I mean, that's why traders look at earnings per share beats. It might not be a big deal that you beat earnings by 3 cents or 7 cents, but it can affect the momentum game. What traders get out of the game is a pricing effect, a mood and momentum story. And if you're an investor, and going back to the investor side, the other thing you can sometimes hope from an earnings report is going to be the catalyst. What does that mean? Remember, you bought a stock because the price was less than the value. Sometimes earnings reports act as the catalyst that caused that gap to close. So what you get out of an earnings report will depend on what you were looking for, what kind of game you came to play. So traders, and the bulk of the people looking at Nvidia are traders, looked at the second quarter earnings report, and what they saw was not the great numbers that I pointed to, the 122% revenue growth, the amazing margins. They saw signs that the momentum might be shifting. Whether they're right or not, we don't know. The sober guidance, the fact that the numbers were not as impressive in terms, relative to the last 2 quarters, and the buyback all seem to come together and suggest that what happened after the earnings report came out was the momentum shifted away from that amazing upward momentum we've now had. And it's not something that happened just around the earnings report. I think that we've seen signs of it for the last few weeks. This doesn't mean that this is the end for Nvidia, that the momentum has shifted, the price is going to drop, because momentum is the strain. I mean, look at how much it shifts over short periods. Who knows what can happen in the next few weeks? But for the moment, at least, the momentum game is working against traders. I'm an investor. I'm a terrible trader. It's not because I think trading is bad or investing is good. I'm just not good at trading. So what I look for in the report is, what does it do to change my story for Nvidia? If you remember, I did value Nvidia about after the first quarter of 2023. I did it for a personal reason. I owned Nvidia that I'd bought in 2018 at a much lower price, and I had to decide what to do. And after my 2023 valuation, where I found Nvidia to be overvalued. I sold half my position. I held on to half. So I decided to revisit that valuation story and numbers to see what the earnings report would do to that story. Let me break it down to pieces. Let's start with revenue growth. What did I learn from the earnings report? That Nvidia is still growing fast. The AI business is growing a lot faster than I thought it was last year. So I've kind of updated the size of the market from 300 billion to 500 billion, partly reflecting that surge in the market for chips that we've seen in the last 5 quarters. And I do think, and I'm not going to change this view on Nvidia, that Nvidia, which controls a dominant part of the market, 80% by some counts, is going to continue to dominate the market even in steady state. Okay? So that's the first piece. 80%, they have an 80% of an $80 billion market now. I see that market becoming a $500 billion market and Nvidia maintaining a market share of 60%. How did I get all of this from the earnings report? Well, a part of it came from looking at the overall revenue growth that they've had over the last 3 quarters and just marveling at the 200% plus in the last 2 quarters and even the 122% now. So the record for the company is kind of changing my views on where the company can be in terms of total revenues. In terms of gross margins, astonishing gross margins, right? And those gross margins reflect the fact that the chips are made by TSMC and Nvidia is able to mark them up. To which a big question becomes, why doesn't TSMC partake in some more? I mean, it can't demand most of the price, but why not? No, why not a bigger slice? For the moment, I think there are enough contracts already in place that TSMC cannot do that, but there will be a time when TSMC or whoever makes the chips is going to ask for a bigger slice of the pie. Nvidia is still going to have the dominant part of that bargaining, but I expect gross margins over time to see some decline, still to amazing levels, 65% by the time you get to year 10. And you're starting to see this at least in the second quarter numbers. The margins have come down a little, gross margin has come down a little bit. On operating margins, I think that the economies of scale that you saw benefiting Nvidia over the last few quarters, those benefits are going to start to scale down. That's what I think the second quarter signaled is you got great economies of scale, but now you're a bigger company. And the second thing to note here is those operating margins also reflect that the immense pricing power that Nvidia has in this process. That immense pricing power, comes from the fact that right now everybody wants AI chips. They're willing to pay whatever Nvidia charges them. But here's something to remember. 40% of Nvidia's revenues come from 4 companies. Not just any 4 companies. There are 4 big tech companies: Meta, Google, Amazon, Microsoft. For the moment, they're paying what Nvidia has them. But trust me, these companies are not sitting there saying, we'll take whatever Nvidia charges. They're looking for other ways to buy these chips that are cheaper. Right now, the competition might not be there, but it'll start to get there. And they're also, I'm sure, thinking about in-house chips. Why pay another company when you can make them in-house? It doesn't mean that Nvidia is going to lose all its sales from these 4 companies, but it is something that will push down the margin over time. Still amazing number from the 67.6% that I had as my R&D adjusted margin to 60% by the time you get to 10 years from now. In terms of reinvestment, I think Nvidia is very strange. As a design company, its big reinvestment is R&D. There's a lag in that process and uncertainty. Both those things play out. Right now, the reason Nvidia is growing is not because of R&D it did last year or 2 years ago. It's because of an R&D 4 or 5 years ago. That lag is going to continue. I do think that because everybody is playing in this space now, every company, every chip company is out there, and even non-chip companies, new companies are entering the space, they will continue to have to reinvest, but I think they will get more bang for the buck than a typical semiconductor company. I'm going to estimate $2.5 in revenue for every dollar of reinvestment, because if you look at their 2023 and 2024 quarterly reports, the reinvestment reflects the R&D has come down as a percent of revenues. Finally, if you look at risk, the risk here is that they're a semiconductor company. Historically, semiconductor companies have gone through cycles. For the last 3 years, Nvidia seems to have immunized itself. In fact, for the last decade, has immunized itself, partly by entering these new markets. But eventually, it's going to catch up with them. So to start the process, I'm going to give them a cost of capital based on the fact that they're a semiconductor company. That does give them a higher cost of capital to start the game, 10.57%, not the 10.57%. And then as we go through time, I think as the growth scales down, you're going to start to see the company's cost of capital come down. Perhaps not to the median. I think they will approach the third quartile of US companies, which is a cost of capital of about 8.5% by the time you get to 2034. So I've taken what I've learned from the report, I've revisited my story. That affects my valuation. So here's my updated valuation for Nvidia. Still an astonishing story. I see the company's revenues going from less than 100 billion to close to 425 billion by the time you get to year 10. I see the company preserving its really high margins, albeit with a small decline, operating margin of 60%. I see the company getting more bang for the buck from its reinvestment, $2.50 of revenues for every dollar invested. And you can see that play out in incredibly high returns on capital. And I think they can maintain a return on capital much higher than the cost of capital in perpetuity. The bottom line is you let the story play out with the numbers I've put in. The value that I get for Nvidia is about $87 per share. Stock was trading at $106, at close of trading yesterday, which was September 5th. Now, this is much closer than what I got last year. It's still overvalued. It's by about 22%. But it's, that difference is the smallest I've seen in the last year and a half that I've been tracking Nvidia. What should you do? I don't think, with all of my valuations, I say buyer or seller beware, because I do my valuations with an audience of one. Myself. I value companies. I act on my valuations. My valuations are not intended to convince you to buy or sell Nvidia. It's none of my business. But I do think, you can take my spreadsheet. It is open access. You should change your story, my story for Nvidia, to make it your story. Come up with your value. And because I'm sure you disagree with parts of my story, but you need to take ownership of your story. So it's a tool. It's a tool that you can use to make that adaptation. Now, of course, I'm sure you're thinking about the half that I sold a year and 3 months ago, and you're saying, don't you regret it now? Not in the least. Because you remember, when I sold it, I said, I'm going to keep half and I'm going to sell half. And this way, either way, I feel like a winner. Because, life is about framing your decisions so you always emerge with a win. In this case, I feel like the half I held on to was a win. The half I sold was a win. And I will leave the whole thing as a win for the moment. I might be delusional, but that's the way I see it. I hope you found the session useful. And I thank you very much for listening.